Hello everyone, and welcome to Mackenzie George and Company's seminar or YouTube video on business valuation. We just wanted to put this little valuation video together to just give you an idea of how our business valuation seminar works. This is just a truncated version of the full seminar, and this is one in the series of our Navigator series, one of the videos in our Navigator series. So we just wanted to go over the main components of business valuation, and this fits into our Navigator series because when we're looking for the right business to buy, of course, we have to do a valuation on the price of the business. What is the right price to pay for a business? You want to make sure that you pay the right price so that, of course, you're not paying too much money. And so we're just going to go through these a few slides. Again, this is a truncated version of the full seminar. We go into more detail when we actually sit down and go through more information. Definition and purposes of a business valuation. Really, the definition is the amount at which a property or a business would change hands between a willing seller and a willing buyer when neither is acting under compulsion and when both have reasonable knowledge of the relevant facts. So all information is available. What is the fair price that would be paid by the purchaser and would be offered by the seller? It's necessary as a part of your personal and corporate financial plan. It's very important to pay the right price for a business because purchasing a business is an important component in your financial plan to build a portfolio of businesses and to obtain financial independence. So we want to make sure that we're paying the right price. We want to capitalize on economic conditions, buying and selling strategies in strong and weak markets. So depending on how the market is at a particular period of time, the price of the business may very well fluctuate. And we also, in the process of determining the price of business, we want to analyze the population demographics in existing and potential markets. For example, if that business is going to be selling a product, but it's just not going to sell well to the population in and around your specific location, it's going to be more difficult to succeed. And we have to consider factors of estate and succession planning, as well as marketability of the business. Is the business marketable? Can we grow the business? So the advantages of having your business and practice evaluated substantiates the value that you're listing the business for, and this becomes an important consideration in your tax filings. You want to have a strong documentation and a process, a firm process of evaluating the business that you buy. It enables you to appreciate the economic field that your business is playing in. It can affect your marketing and your operations strategy. So actually having your business or your practice evaluated, or the business and practice that you want to purchase evaluated, you're able to find out certain issues around marketing and economics of the business that you would otherwise not have known had you not gone through the process of having your business professionally evaluated. And it also puts you in a position of authority when you're dealing with a potential purchaser if you were selling the business, or if it would put you in a position of authority with the seller if you knew what the business could be purchased for. So when we're going through the valuation process, first what we do is we do a site visit. We just want to kick the tires a little bit and go around and look at the business and evaluate the management team as well. One of the most important components of the business is the management team that's in place. Now, if this is a small practice like a food franchise or a grocery store or a professional practice, you're really not going to have a management team. That you could really replace that phrase with staff. You really want to make sure that you have really good staff on board. They're really going to make or break your business. Staffing becomes the most important component in building a business. We want to do our due diligence research. We want to research the market and the industry that the business is in. We also want to research the economic conditions, because economy is going to affect the price that we ultimately pay for the business. And if your business is one that has that can reach out internationally, then you'd want to look at international economic conditions. Of course, we would want to gauge in financial ratio analysis. We've gone through our table of ratios in other seminars where we look at the Power sequence, profitability ratios, activity ratios, leverage ratios, liquidity ratios, and rate of return ratios. And we have parameters that we want to see in businesses, and those those parameters are in that table of ratios. That we want businesses to meet those parameters, because if they meet those parameters, then we have an indication that we have a good business on our hands. And we'd also like to do forecasting of our sales and cost components, just to substantiate our numbers. The next thing is to develop a pro forma statement. These are just forecasted income statements. What is the business going to look like in the future, given the variables that are in place at the present time? We want to do a working capital analysis to make sure that there are sufficient cash inflows to meet our ongoing liabilities. And we would also want to do a pro forma on the balance sheet, the income statement, and the cash flow statement to see where financially we are. If we need to take credit facilities out to purchase the business, are the cash flows going to be consistent enough, and are they going to be enough to handle the payment requirements on those loan facilities? There are various valuation methods that you can use to value a business. The three main ones are the asset-based approach, or the market approach, the income approach. The asset-based approach really values your business based on the fair market value of the assets at the time of purchase. And the market approach really goes out into the market and asks the question, well, what have similar businesses been sold for? What have they been purchased for? And then we make a valuation determination based on that. The income approach, we really take the present value of forecasted profits and bring them back to the present time, and that forms the basis of our valuation. And then future things we do after we've gone through these approaches, we'll do valuation reconciliation using weightings. Usually you place heavier weights on profits that are closer to the present time. Forecasted profits 3 years out don't have as credible a weight, just because in 3 years' time we really don't know what's going to happen. We also want to do taxation due diligence. We also want to make sure that we as the purchasers or the sellers were structuring the deal in a way that's most tax efficient for us. Two ways really to sell a business. You can either sell the business can either be sold by selling the shares of the corporation that holds the business, or the seller can actually sell the assets of the business. And each one has tax advantages and disadvantages for both the seller and the buyer. Usually a seller may want to sell the shares of the business because he or she may have access to the capital gains exemption, and the purchaser may want to buy the assets of the business because there are advantages with the book values of assets that can be depreciated going forward. But that's a situation that we need to speak out with you if you wanted to go ahead and purchase a business. We'd want to do a determination which way is best to go, a share sale or an asset sale. And we just went over the benefits to the seller of selling the share. Capital gains deduction, they may be eligible for the capital gains deduction. The corporation remains active because the shares are just sold, but the corporation does remain active in these situations, but there is a lot of due diligence required. The asset sale, the seller's business, sometimes it can be pro buyer. You write off the depreciable assets at increased values. There's also, the purchaser can also form a new company and put the assets into a new company. The cash, accounts receivable, and liabilities will remain with the seller unless the AR is negotiated otherwise in the price. A few more things before we end up here. A number of things to consider when you're putting together a purchase agreement. You'll be working with lawyers to put together a purchase agreement when you're transacting the sale of a business. The number of the shares and purchase price. Both the seller and buyer will have representations and warranties related to the business. We also want to iron off all the tax issues that will be relevant in a business. And all the shareholders have to consent to the sale of the business and the purchase. The shareholders of the company that's going to be purchasing the business, they also have to consent to that. So in the purchase agreement, one of the legal documents that you'll have is the consent of all shareholders to the sale and purchase of the business. We also have to consider employment-related issues. When the vendor sells the business, of course, the employees are going to now have a new owner. Are there issues there related to the employees eventually leaving the business? Well, we as the purchasers want to make sure that the employees are not going to leave the business. They could be main employees that really contribute to the success of the business. So we have to take care of those issues too, to make sure that good employees are going to stay on. And any closing conditions that may arise, we have to, again, exercise due diligence to see if there are going to be any barriers to the closing of the deal. Special concerns about corporate liabilities. Well, we have to look at the liability section of the balance sheet to see if the corporation, if the seller is liable in any way. Are there any liabilities on the balance sheet that have to be taken care of, might have to be adjusted in the eventual sale price of the business? So that's a quick snapshot of business valuation. We hope you enjoyed it. We do have a more extensive seminar that we offer on business valuation, but this is just intended to be intended to be an introduction to the valuation process, because at some point in time, after doing a financial statement analysis of potential businesses, you as the purchaser want to go ahead and actually purchase a business, and now you have to consider the right price to pay. And it's good to go through a process that's definitive and that's comprehensive to make sure that you're paying the right price and that it's structured in the most tax efficient manner. So that's it for now, and thank you for joining us.